This is a weekly presentation of the Silicon Valley market conditions for the week ending June the 13th at midnight, presented on Saturday morning, June the 14th. These are the key chapters you can jump to. The timestamps are in the YouTube description below. Let's get into the first summary slide. This is looking at the number of offers that were accepted in just the past week, and you can see that you're basically right on top of the blue line for the last 18 months. What's that saying? It's saying that we're selling roughly the least number of homes that you would expect to sell. The gray is where the 10-year median is, and the red is the 90 percentile for the 10-year period of time. We're clearly having a lack of offers, but we have been in that condition ever since the 2022 price correction. So basically the second half of 2022, all of 2023, 2024, and now the first half of 2025. Here is a summary slide, and the key takeaway is if you look at everything that's highlighted in the green at the top here, these are comparing that particular metric to its 10-year median, and where do we stand? So when you have 149% for, say, the central area of San Jose, that says that you have 50% or 49% more inventory than you do based on the 10-year median. You have 78% of the volume of sales that you would expect. Your turnover rate of the market is 71% slower than you'd expect. Marketing time is 2.5 times what you want. And marketing time for me is defined as how long it takes 3 out of 4 sellers to sell. And this is sort of a weird number, but the 92.5 percentile seller is taking larger price reduction than they normally do. You're taking essentially more price reductions, even though the number is a low number. And then the frequency of the price reductions is 44% more common than it typically is. Then when you come over to these highlighted yellow ones, those are sort of the leading indicators. So what it's basically doing is saying, even though over here we clearly are favoring the buyer when you compare to the 10-year median, when you look at current market conditions, it's still a pretty aggressive marketplace, pretty much favoring the seller. How do I reconcile those two things? Silicon Valley is normally a raging hot marketplace for the seller. And now what we've done is we put a little bit of damper on that. So it's still a hot marketplace where if you come on and you're priced right, you can still sell in the first or second weekend on the marketplace. But that is slower than we are typically. And that's hard for a lot of people to grasp for some reason. So we're still a good marketplace, but we're not as good as we are typically for Silicon Valley. Then the overbidding is a lagging indicator because of the need to close of escrows to happen in order to get the sale price. Then you have the long-term appreciation, which has nothing to do really with current market conditions. And then the median price in the middle, the cheapest price you'd expect on the left-hand side, median in the middle, and most expensive on the right-hand side. So now here are the summary slides. And what you're seeing here is you're doing the same concept. The gray line is the 10-year median. The red is the line that would favor the seller the most. And the blue is the line that would favor the buyer the most. So you can see that we're favoring the buyer, which means we have a lot of inventory. And that's why the graphs are up at the top. So you have more inventory than you typically do, but a little bit less than the most inventory you'd expect. And over here are the actual numbers. The most inventory you'd expect for this week, based on the last 10 years, is 3,360. We're at 3,250. So you're only 110 listings short, and out of 3,000, that's a pretty small amount, which is why they're so close together. These numbers over on the left-hand side is where we were a quarter ago. So as far as inventory, we went from 120% of where you'd expect to be to 122% of where you'd expect to be. So really no change. In other words, we have 20% more inventory than you'd expect, but it's been growing at the rate you'd expect it to be, which is why that percentage is staying the same. But now if you look at the same thing for offers, you've gone from 89%, so missing 11% of the marketplace, to now missing 21% of the marketplace. So we're missing almost double the number of transactions on a percentage basis. We're sitting there at 2238 transactions. The fewest you'd expect is 2243. So basically, we're having fewer transactions than you would expect. And that's why if you look carefully, the purple line is just below the blue line on the current week, which is labeled this in the middle of the graph. So to the left of this is the past 13 weeks. To the right of it is the future 13 weeks. And clearly, I don't have the data line, the purple line, but I have the trend line. So you get a sense of what the market is likely to do. It's not a prediction. This is track record based on the past 10 years. The purple is what the market's actually doing, which is why it stops at the current week. Number of transactions. This is simply to show you the number of actually closed transactions, because that's what the number of real estate agents that are happy, the number of title companies that are happy, termite, home inspectors, the whole 9 yards, because they all get paid at close of escrow for the most part. You were at 87% of the transactions a quarter ago, and now you're at 76%. So, and you've lost, what is that? That's 11%, and you've lost 9% in the volume of your transactions. So your TFT ratio may be very slightly elevated compared to the 10-year median. I have no accurate way of knowing what it is. It's too time consuming to get the failure rate. And also with late reportings and early sales and people reporting listings differently, it would be hard to know if a transaction had an offer that was ratified and then fell through. Days on sold inventory is sort of the turnover rate. It's sort of the seller supply buyer demand ratio, supply demand ratio in economic terms, turnover rate in loose lingo. It's the speed of the marketplace. Basically, you're up here at 50 days, 51 days, which is actually quite a bit. If you come over here and look at the numbers, the slowest you'd expect is 42. So we're actually 50% slower than we typically are. We're typically at 33. So that's where you can see, yes, 51 days is still a very fast-paced marketplace. Most of the country considers 3 to 7 months, which is up to 210 days to be a normal marketplace. Silicon Valley has never been in that realm. I consider normal to be basically 7 to 40 days. So basically 1 week to 5 weeks or 6 weeks, depending on how you want to look at it. This is marketing time. Marketing time is the time it takes for 3/4 of the sellers to sell. And you can see it's been climbing. It's been climbing earlier. There's been a horizontal date shift for whatever reason. And it's the first time it's happened since I started following the data, where the peak of the marketplace happened right at the end of the year instead of halfway through first quarter. The bottom, where the market's the fastest, happened at the beginning of second quarter instead of halfway through second quarter. And the trend is continuing. You can see that normally the gray line doesn't really start picking up until just about this week, because you can see it's been pretty flat. In fact, there's a little bit of a down here on the left-hand side where the purple line's turn around and has been steadily climbing. Now it's climbing at about the same rate as the blue line. It's just it's been shifted. You know, the bottom of the blue line is, say, maybe rated this week here 6 weeks ago, and yet the bottom of the purple line is clearly more like 13 or 12 or 13 weeks back. So for some reason, it seems that length of time for sellers to sell is increasing earlier than it typically does. We're currently at 28 days, which is still, again, fairly quickly. For 3/4 of your sellers to sell in under a month is fairly fast, but that's basically 2/3 slower than it typically is. Typically, you're down here at 17 days, and 2/3 of 17 is going to be about 11 days, and then 11 on top of 17 is your 28. And that's how the math works out for those that are interested. Price reductions. Normally, a quarter ago, we were only taking 0.5%. Now, normally, you're going to be taking 0.6%, so a slight increase. But we're actually taking double that at 1.3% increase, which is why you're about 208% more of a decrease. So there's clearly more price reductions. Now, that could be more frequent price reductions or larger magnitude when you're talking about the average price reduction. And that's what we're talking about here, is the average price reduction. Overbidding is a strict number basis. Normally, a quarter ago, you'd be expecting 6% overbidding, and we were actually getting 8.7%. So you can see that just 13 weeks ago, the purple line was significantly above the gray line. Now you come over here and you're down and you're approaching the blue line. In raw actual numbers, you'd expect 7.8%, 7.75% overbid. Here you're getting only about 5.33% overbid. So you're down by 2.5%. And I don't calculate the percentage on this. So 7.8 is what you'd expect. We're at 5.3. So you're 2.5% less overbidding than, and this is magnitude of overbidding. It's not frequency, it's magnitude. Here now is the key indicators. The purple is the number of inventory, how much supply is there. And you can see that we're about 122% of where we'd expect to be. You can see we've come down from where we were just a little bit earlier. And why we turn around, you know, I don't have any explanation, but we clearly turned and we've come down. Will it continue to go down, or we'll turn around and do this abrupt back up? We had a false back up just about 2 weeks back. I'm going down to offers accepted. Offers are the orange line, and you're right at 80%. And if you look at it, you know, we spent most of 2024 at 80%. We spent most of 2023 at about 70%. So even though 80% is missing 20% of the market, and more than any time other than post-pandemic, because if you come down pre-pandemic, you're basically much closer to 100%. So this lack of offers is a post-pandemic feature. And I think what's happened, first off, you had a fair number of transactions right here, right after the pandemic, when everybody's housing needs changed. So everybody moved. That takes away some of the future transactions. But I think the bigger thing is owners of properties refinanced, and now they have a 3% 30-year fixed mortgage, and with interest rates around 6.8%, they're not inclined to move. So I think we may have fewer transactions going forward for an extended period of time because of the interest rate differential. And then the last line up here is the days unsold inventory, which I actually think is the more important. It's the speed of the marketplace. And that is actually about 154%. So it's slower by 54% than it typically is. And more significant, in my opinion, is you draw the line horizontally back. And the only time that you had this level of slowness was a very short window at the end of 2018, which was not a good period of time. And also during the shelter in place when we couldn't even show properties. So even though the actual days of unsold inventory is a fast number, I think it was somewhere around 50 days, the fact that we're at basically a record high DUI, and high in DUI is a slower marketplace, is significant. Now we're going to look at each one of the components. Here you're looking at active inventory. The gray line is where you'd expect the data to be. The red line is the least you'd expect. You can see that we had a limited inventory in 2024 and also very limited inventory in 2023. Now we have that surplus inventory. So it is going to be interesting to see what happens while we have the surplus inventory and a low number of transactions. Here's on a percentage basis. So you can see that inventory is basically at a record high since the pandemic. And in fact, the only time that was higher is right at that end of 2018, beginning of 2019. And Silicon Valley overall really wasn't impacted by this. This was mostly Santa Clara County was sort of unique. What happened was in 2017, there was 2 years of appreciation, one typically in January, a second one in August. So in 18, we were ahead of the curve on appreciation in Silicon Valley, and that pulled down Silicon Valley overall because Santa Clara County is close to it's more than a third, and it's less than 50%, so some odd number. Alameda County and Santa Clara County are roughly the same, and San Mateo County is a much smaller county, about half the size. So yeah, I have roughly about 5 counties, and Santa Clara and Alameda are about 2 out of the 5 counties, or about 40%, and that's probably fairly accurate. But anyway, we have more inventory than expect, but we have come down from our peak just a few weeks ago, so that's encouraging. Here's the same concept with the number of offers. You can see the number of offers right now is right on the blue line. It looks like we rolled over maybe a week or two early, but that's not a big deal. The big deal is going to be whether we stay on the blue line, whether we improve and come up to the gray line, or if we get significantly below the blue line. And again, you can see that we've had a lack of transactions basically since halfway through 2022. And in fact, you can see here at the end of first quarter of 2022, was sort of the peak, and the number of sales has fallen off ever since. Now, 2023 was worse than 2024 for the most part, and 2025 is very similar to 2024. Here's on a percentage basis. You can see that we have 80% of the offers, and you can see the same thing. Most of 2024 was at 80%. Most of 2023 was at 70%. This is the days unsold inventory. So again, a high number here is a slow marketplace. So you're about 51 days right now to sell the entire set of inventory in Silicon Valley, down slightly from our peak, which was about 6 weeks ago, I would guess. But it's still higher than the highest you'd expect. And that's the thing. So even though this 50 is still a very reasonable turnover rate, the fact that you're significantly above the slowest, longest, highest turnover rate that you'd expect is significant. Here's on a percentage basis. So on a percentage basis, you can see that you're higher than any time other than right there at the end of 2018 and during the shelter in place period of time. And we're something like 155% of typical, and typical would be right here on 100%. Here's marketing time. So here's where you can see the shift. So see how the peak is normally halfway through first quarter. It happened right at the beginning of first quarter, or even a week in the end of fourth quarter of last year. It dropped down just like the gray line does, and it bottomed out, but the bottom out in the gray line is typically halfway through second quarter. Here, they bottomed out halfway through first quarter, and it's been climbing. So they're more than a vertical shift. for some reason, there seems to be a horizontal shift, which I have no explanation for. And if you go back and look at it, you can see the purple peaks very consistently after the first of the year. So the fact that we peaked the week before the first of the year is significant, and the fact that it's not after. And when I say significant, I don't know the significance of it, but it's noteworthy is basically what I'm saying. It's something to pay attention to. Here's your marketing time versus typical. So we're at about 165% of the length of time. And you can see the only time it was up here is right during the shelter in place. And I may have to expand my graph in the not distant future if this continues to climb, because I want the data, especially the current data, to be on the axis. Here's the largest 10%. So what is the 90th percentile seller taking? And right now they're taking about a 12.5% price reduction. So that's pretty significant. And you'd expect them only to be taking about a 10%. So they're taking about 2.5% larger price reductions than you'd expect them to be taking. Here it is on a percentage basis. Yes, there's been periods of time when there was larger, basically when people were waking up to the correction in the pricing in 2022, here in the second half of 2022, and then the first half of 2023. But then people got realistic again, and the price reductions became more reasonable. Again, there appears to be a fairly significant change right around Valentine's Day, where you can see the percentage went from 90 up to about 150. So that's a pretty significant increase, well within a quarter. And now we've been bouncing around somewhere around 150%. We're coming down as sellers and agents get used to the new marketplace. Here's the seller's average ask price. I don't particularly like it. I do it just to show you that I'm not playing numbers. It really shows the same trend. You're taking significantly more because it's the vertical separation. So from probably about there down to here. So normally your price reductions would be about 0.7%. And right now it's about 1.3. So almost double. So similar magnitude, but not quite as big as the 90 percentile. Here's on the typical average. So you can see there's been periods of time when we've taken more price reductions, but when the large number of price reductions are occurring like this, it would tend to indicate that the market slowed down in the recent time prior to that. Here's the frequency of price reductions. So how many sellers are participating? So even though the number was pretty large, you can see that only about 19% of the sellers are participating by reducing their price. The other 81% of the sellers are coming on the market and they're pricing their home according to the market before they put their house on the marketplace. And that's challenging right when the market changes. It becomes easier as you get further away from that market shift. Here's now the frequency. You can see it's right at 60% greater than normal. You can see we spent most of 2024 with the normal number of price reductions. Very early in 2025, we had less price reductions than you'd expect. But basically, starting at Valentine's Day, the number of price reductions started to increase and had been climbing constantly until about 2 weeks ago. And now we're on a downward slide. The downward slide may just be some corrections like we saw back here, or it could continue and we could get back to a normal marketplace. Here's the magnitude of overbidding. So this is the median overbid. So the median overbid is 2.5%, where you'd expect it to be up here around 5%. So that was the 2.5% difference. And sometimes I quote the average. If the number's up around 5 and 8%, that's typically going to be the average. If the number's more like 4 or 5 or 2%, that's more likely the median. And I try to label my graph so you can see it's labeled median. Here now is the price magnitude overbidding on a percentage basis. So you can see that even though a seller getting 2.5% more than their asking price would be a positive thing, you can see that we only had a very short period of time right on both sides of New Year's of 2023 and also right after the pandemic shelter in place period where you had larger, less overbidding than going on now. So Silicon Valley, unlike most parts of the country, typically have overbidding. And even though we're currently having overbidding at almost 2.5%, that is less than we normally are. Here is the frequency of that overbidding. You can see right now still more than 60%. That's about 63.8% maybe would be my guess of the sellers are getting an overbid. So not quite 2/3, but more than 60% of all sellers in Silicon Valley that are closing in the last 5 weeks got more than their asking price. You can see that we were up at 3/4, so we've clearly come down and we're below the typical. And you can also see the transfer. Again, there seems to be a horizontal shift in the time, moving the calendar cycle that we go through every year forward in the year. Here's the frequency of the overbidding. So we're now at only 85% of the typical amount of overbidding. You can see we had slightly more overbidding in 2024. So the fact that we're below is significant. Also significant is look at, there's only a short periods of time when you had less overbidding than you do right now on a percentage basis. Here now is a quick little price model. One is to just say what's the average price variation since the last 9 months of 2014. And basically it's 11.4%, or break it down a little bit more accurately and say it was 12.8% and then 3.3. You could almost argue that it was a little bit higher and completely flat for the last 3 years. That could be a model that someone would put out forward, and the data supports that. With data, you really, yes, you can calculate the mathematical, but, visually, is it really here where we're slightly above right now, or is it more like the blue line? So it just gives you an idea. And the advantage of plotting on log paper is when you draw the straight line, that is your rate of appreciation compounded. Now we're moving on to distribution. So every line on here is a distribution. We're looking at from the 50 percentile, from the median up to the 90 percentile. So the seller that's taking the longest to sell their property. And the reason I do this is you can see how convergent the lines get on the left-hand side here. Showing you all the lines close together really doesn't gain you anything. I focus on right here on the 75th percentile seller. You can see the purple line is the current data. The dotted line is where we were a year ago. So we're clearly longer across all the market. And we'll step through, and we start off at a week at a time, and then we jump 2 weeks at a time. So this is all the 1 week. Now we're going to start going 2 weeks at a time. And that's just because we don't want to take up all day going through all 52 weeks. You can see you're pretty level here. And then you're going to start increasing, slowing down right at the end of the year. There's the peak, December 20th. Now you're already accelerating on January the 3rd. And now there's the peak of the marketplace. And I'm froze that just so we can show that's February the 14th. So that's one of the reasons I'm saying that it appears that just like in 2022, the market peaked on Valentine's Day or middle of February. Then we continue on, and you can see that you've been slowing down in 2025. And now you're rapidly approaching the current purple, which is coming up next, I believe, right there. Yep. So now you're at the purple line, and based on the dotted lines went up. So I'd expect the marketing time to continue to get longer. Doing the exact same thing on price reductions, purple line, the current data. This is where we're going to start off a year ago. So let's see, you're cooling off a year ago, then you improved after a couple weeks. And now in the middle of July, you're just bouncing around. So you have that summer doldrums where there's really not much of a market shift. It's sort of lazy summer days. And then when we get past Halloween, see right now you're a huge price down, and right about there, the 20th of December was the slowest in the marketplace. And again, there's the peak of the marketplace, and surprise, it's Valentine's Day of 2025. And you can see how much we jumped downward just the next week. Very little, but then the 4 weeks later, you jump down quite a bit. And that gives you some slack. Was it really middle of Valentine's Day? Was it the 21st? And remember, I'm only showing the slides for every 2 weeks. But again, you can see that we're taking significantly larger price reductions this year than we did last year. The last distribution is overbidding. This is going to be lagging because I need the close of escrow information. You can see a year ago, we were up here at about the peak of the marketplace. You can see there's very few lines, if any, above. There's a couple lines above right here, but down through here, the dotted line from a year ago is sort of at the hottest time of the year for the marketplace. Here was the purple line. We're actually almost one of the coolest lines, but we'll step through. You can see that we already are cooling off a year ago. So that would mean the purple line will likely cool off from where it's currently at. We're going through, we're sort of at that summer doldrums where you're really just bouncing around. And because we need sale price, this lags behind. So this is not going to start improving until, or generating until Thanksgiving. Right there, January the 3rd. There's the bottom of the market on January 31st. Market accelerates rapidly. And there's March 1st. That's roughly where the peak of the marketplace is on overbidding. Now, if we step forward, we'll see that it doesn't change that much the following week. See, there's really not a change. There's really not a change. So it could be as late as March 29th, where in the peak of the market was. And then if you take off your 5 weeks for the close of escrow, you're back more in the February timeframe. So I think even the overbidding supports a market shift somewhere in the mid-February timeframe. Now you can see you're starting to cool off, and that would indicate that we're going to be cooling off. The dotted lines when we took off down here, this purple line will probably cool down. Here now is the 3 counties done individually. Orange is San Mateo County, blue is Santa Clara County, gray is Alameda County. You can see Alameda County is back up to the inventory it had before the pandemic. Santa Clara County is still below. San Mateo County actually has more inventory than it's ever had. You look at the 600 line, because we're the 600 line, come back, and in no time in the last 10 years has San Mateo County had more than 600 listings. So San Mateo County actually has a significant surplus of listings of the current moment. Offers accepted. San Mateo County with a surplus of inventory is down. It's nowhere near its record high level of offers accepted. So it's going to have a slower or longer DUI than normal for San Mateo County. You can jump up here and look at Santa Clara County is above Alameda County. So even though Santa Clara County had less inventory, it has more sales than Alameda County. So as we see on the next slide, Santa Clara County in the blue has the fastest DUI, the quickest turnover rate. San Mateo County is second at over 50, and Alameda County is the longest at about 57 days to turn over the marketplace. That's the length of time it would take to sell all your housing at the existing rate of sales. Here's your marketing time in the 3 quarters. You can see the time for 3 quarters of sellers to sell is basically the same for San Mateo County and Alameda County, in large part, because San Mateo County did a fairly significant increase just last week and went from about 26 days up to 31 days. So that's a 5-day increase just in the last week. That's pretty significant. Santa Clara County in the blue has the fastest marketing time at about 25 days to sell 3 quarters of the properties. Here's the magnitude of price reductions. This is average. You can see that Alameda County is taking the most price reductions. Santa Clara and San Mateo County are very close behind and are exactly equal at basically, call it 1.2% price reductions for those 2 counties, and Alameda County is at 1.4% of a price reduction on average. And the reason the average is so small is the vast majority of the sellers, I think the number was 81%, are doing no adjustments at all. So when you bring in all those zeros, the average becomes close to 0. The frequency of price reductions, Alameda County has the most price reductions, followed by San Mateo, and Santa Clara is actually down here a little bit. So it's actually about 1% lower than San Mateo County. Here's the magnitude of overbidding. You can see that even though Alameda County had the longest marketing time, the slowest DUI, most inventory, it's got the most overbidding. I believe what is happening is sellers are coming on the marketplace, are not selling, are adjusting their price, giving them long marketing time, giving them large price reductions, but then they overshoot the market. So the buyers are coming in and buying properties shortly after a price reduction, but are overbidding, maybe up to the original list price, could even in some cases be higher than the original list price, where people don't have. We're at a marketing time where it's really important to be successful in selling. You price your home to excite the buyers that are on the fence. There's the frequency of overbidding. Alameda County's got the most frequent overbidding. San Mateo County second. Santa Clara County is the least, but they're all fairly close together, because from 62% for Santa Clara to 66% is only 4% or a 10% swing. So that's pretty close together. And you can see that they generally are fairly close together. Here's the long-term appreciation. This is where Santa Clara County really shines. 120% appreciation since 2015. San Mateo County and Alameda County are very close together at about 85% appreciation. So Santa Clara County has done almost 50% more appreciation than Alameda County and San Mateo. And most of that differential has happened since the pandemic. You can see prior to the pandemic, the lines were together. And since the pandemic, and really since 2023, the blue line, Santa Clara County, has really pulled out in front. So if someone can tell me why Santa Clara County has become so much more desirable since 2023, I'm yours. Here now is the median sold price. We reverse. San Mateo County is now back on top. They're very close together, but Santa Clara County is in second. Alameda County is still the most affordable. And here you can start seeing that Alameda County has basically been flat on prices. San Mateo County has been close to flat in prices, but Santa Clara County is above their previous peak. And it becomes real evident if you come back to the 2022 peak. San Mateo County is below, Santa Clara County is above, and Alameda County is below. So two counties are below their previous peak. Santa Clara County is above. Here's the median sold price just on regular paper. The previous was on log paper, so it's the same information. Here are the estimated payments. I go through a formula, assuming 80% loan balance, 30-year fixed at the Freddie Mac, high balance conforming for the nation. Misleading in the fact that jumbo money is cheaper, so the payments would be lower, and also a lot of people put more than 20% down, especially on the higher end properties. Here now are the heat maps of the different metrics. Break down Silicon Valley into 20 different metrics. You start off with all of Silicon Valley up here. You can see the hashed lines to try to draw your attention to it. Then Santa Clara County, and then the micro markets that are under Santa Clara County, San Mateo County, its micro markets, and Alameda County and its micro markets. For the first couple slides, I don't have micro market data, and that's why they're all the same. Blue favors the buyer, red favors the seller. You can see this is mostly blue. A little bit of white here on the right along the Santa Clara, San Mateo County border, which is about normal inventory. Here's the same concept with the number of offers. Again, very blue in color, more blue probably than the inventory. Now here's your speed of the marketplace, and these are all compared to the 10-year median. You can see that you're slower than you typically are, which is why these are longer days on sold inventory. The exception for being shorter is Cupertino, Sunnyvale. They're actually about 8.5% faster than they typically are. Everybody else is slower. This is marketing time. Even though Cupertino had a faster DUI turnover rate, its marketing time is longer. Look at Saratoga Los Gatos. Its marketing time has shot up to 4.5 times longer than it typically is. So some of these numbers are getting to be pretty big. Clearly, you can see the time for the typical seller, the 3 out of 4 sellers to sell, is longer than you'd expect for this time of the year. Ask price reductions. Notice there's some pink. Now, granted, these are areas where you've had limited appreciation, but there's definitely pink. There is also a fair amount of blue. I would say there's more blue than pink, and the pink is fainter than the blue, but again, it goes on both sides. Frequency, Palo Alto, Los Altos has very little price reductions going on, as well as the island of Alameda up here, up by the word San Francisco. You can see Los Altos, Palo Altos, only 78% of the sellers that are normally reducing their price are reducing their price now. This is days unsold inventory. Now we're getting rid of the comparison for the 10-year median, and we're simply looking at what the raw count is. So here it's a lot more favoring the seller. And that's what I was trying to say earlier is even though we're slower than we typically are, it's still a fairly strong seller's marketplace. Here's the marketing time for 3 out of 4 sellers. This is fairly balanced with some strong areas in Cupertino, Sunnyvale area. Here's the ask price adjustments. I would say it's mostly pale blue or white in color, which means price adjustments are still fairly typical on the average. This is the frequency of those price reductions. So the heart of Silicon Valley is actually taking very few price reductions. It's sort of the outlying areas that are white in color or blue in color. Here's the buyer's overbid. This is the average. So you can see in Silicon Valley, 5.3% overall, Santa Clara County at 4%, San Mateo at 4.6%, and Alameda at 7%. So Alameda County is really out there, in part because Berkeley, Alameda City of is almost at 20% overbid. So that sellers are getting 1/5 more than what they're asking for on their sale price, which is just insane when you think about it. This is the buyer frequency of overbidding. So how common is overbidding? And you can see that Silicon Valley wide, 63.5%, very close together. 61.2 is the least amount of overbidding for Santa Clara County, followed by San Mateo County at 63.6. and Alameda County at 65.8. But the range is pretty significant in each county. You know, the lowest I'm seeing overall is 33%. So 1/3 of the sellers getting more than their asking price in Half Moon Bay. And the highest number I'm seeing is 86% in Berkeley. So almost 90%, almost 9 out of 10 sellers are getting more than their asking price in Berkeley in the city of Alameda. Here's the long-term appreciation. So this is not the conditions in the marketplace, but where you've done the best at investing since the last 9 months of 2015. And clearly the San Mateo Peninsula area is doing the least well with a lot of blue, and the heart of Silicon Valley and even the southern part of Alameda County has got the most red, which would be the highest rate of appreciation. You go from a low of 82% for Alameda County. I guess it's areas like Oakland and even the Alameda, because the Alameda is only at 68%. Oakland's only been at 44%. Is that? And Redwood Shore is 43%. Small market area, Coast at 45. So somewhere right around 45 is the low end of the appreciation rate. And this is actually an interesting observation. Santa Clara County has 119% appreciation, but the highest any given area is Campbell at 105%. So how can you explain that? It's simply that fewer low-priced homes are selling and more expensive high-priced homes are selling. So you have market mix shifting, causing this to be at 19%. Here's the sold price, and instead of following just the median number, which is the middle number, on the left-hand side is the cheapest 10 percentile you'd expect to find in a given area, and over on the left-hand side is the most expensive 90 percentile you expect. So you have a sandwich. You have basically a price range for each one of the micro market areas. You can see Atherton right off the bat is the most expensive area, and looks like Oakland is probably the cheapest area. So there's quite a bit of range in the pricing range. Here is a summary of that information. And again, the greens are where you're comparing year over year. So how is Silicon Valley compared to Silicon Valley for the past 10 years? And frankly, that's favoring the buyer. It's a lot of blue, but then you come over and you start looking, what are the actual conditions? And for the most part, they're fairly balanced or slightly favoring the seller, I would say. And then the overbidding is still favoring the seller strongly, but that's a lagging indicator 5 weeks in the rearview mirror for the length of escrows to close, and then appreciation. And here you have the sold price. And instead of just following the median, as many people do, I sandwich it. I put it in the cheapest 10 percentile and the most expensive 10 percentile. So you have a price range in each of the 20 different micro market areas. And here, the affordable areas are the blue. So the most affordable area is down here in Oakland. The least affordable, the most expensive area is up here in Menlo Park and Atherton. Here's the sales volume, and we now are back to the second lowest year. The only year that had less transactions than we currently are is 2022, and that's true for the 10-year as well as the 25-year record low number of transactions. You can see that we're in the bottom two earlier in the year. We got up to the bottom 3 and 4. And now we're back to the second worst as far as volume of transactions. Here's the actual raw numbers across Silicon Valley, Santa Clara County, San Mateo, and Alameda County. You can look at whatever number you want. This way you have the actual numbers. You can see that things are starting to level off. Number of new listings for the last 5 weeks is actually down a little bit across all 3 counties. The number of active listings is sort of anywhere from completely unchanged to up 2.6%. The number of offers is mostly down, especially because of the Alameda. So Alameda has had an increase in inventory and a decrease in sales, causing their DUI to go up by very close to the 5, which is the threshold of a changing marketplace. So 4.6 is getting pretty close to 5. Santa Clara County actually improved. You have the appreciation since the last 9 months of 2015, as well as since the entire calendar year of 2020. We have been talking about the Silicon Valley real estate market. We will be talking about the Greater Bay Area, 13 counties and 5 regions next. I'm Richard Calhoun, real estate broker with Creekside Realty, working with single agency transactions. If you have a real estate need, feel free to reach out. Or if you have a question about the statistics of the market, feel free to reach out. If you want to get to the YouTube channel because you want to look back at an old episode, you type in the blue YouTube archive link here, or you type in just the short green root URL. To join the presentation Saturday morning at 9 a.m., type in the green root URL in 2025. Also, I'm curious, send me an email, send me a comment, call me up, whatever, however you want to reach out. If you'd like to have a discussion later in the week to discuss the market conditions. In other words, I would do the presentation Saturday morning live, get it up recorded, let people have an opportunity to watch it, and then maybe Tuesday, Wednesday, or Thursday, set aside a half hour or so and see if anybody wanted to have a presentation and call up and ask questions. If you'd like that, reach out to me in some form and tell me what day and time. The handout I try to get out 15 minutes before 9 o'clock, and it was up today at that time frame. The green root URL, the letter H for handout, the year 2025, the month 06, and the date 14 gives you roughly a 70-page PDF of the PowerPoint presentation that you can look at, and you do your own analysis. If you want a specific episode, you can go directly by typing in the green root URL, the year, month, and date code. Appreciate any subscriptions if you're not already a subscriber, and appreciate likes every week. Here's the Greater Bay Area, includes 5 regions. We have talked about the Silicon Valley. Then you have the cities, North Bay, Central Valley, and the Central Coast. This is for single-family homes for the past 5 weeks. And we're using the 2015 through 2014 as the reference years. Here's inventory. Inventory is basically coming up in all the areas. You can see Silicon Valley is actually getting close to its record high, in part because San Mateo County is above its previous record high. So San and Clara County is pretty close. North Bay is pretty close. Central Valley is still lagging behind. Central Coast is pretty close, and the cities is fairly close. So pretty much we're getting back to the levels of inventory that we had pre-pandemic. Level of offers is still down. Silicon Valley is probably doing the best because if you look at it terms here, all 3 counties here are doing roughly the same. Now Silicon Valley is doing the best, followed by North Bay and the Central Valley. So clearly these two are significantly lower. And then the cities and the Central Coast are down here, and you have to compare them to just themselves. They turn out to be roughly the same magnitude, and the cities is closer to their old level than the Central Coast. Here's the speed of the marketplace, the turnover rate. You can see Silicon Valley has the fastest turnover rate at about 52 days, maybe. Then you have the cities, Central Valley, North Bay, and the Central Coast at 100 days. And again, keep in mind that this is what a lot of the country considers 90 to 210 days to be normal. They quote it in terms of months, 3 to 7 months. That's why I do days, is because we're rarely over 3 months. And when I say we, that's Silicon Valley. Central Coast does tend to be a slower metric, because even when I had Silicon Valley from 40 to 80 days being a balanced market, the Central Coast was 50 to 100 days. So this 100 days would still be considered a balanced marketplace in my book. Here's marketing time. This is how long it takes 3/4 of the sellers to sell. You can see it's climbing up in all the regions, probably going up the most steeply in the cities, but climbing in all areas. You can see how quickly they dropped down earlier this year in all regions. The timing is a little different. Notice how the Central Coast is the last to come down. It's mid-quarter, where everybody else is fairly early on first quarter, where they start decreasing the marketing time. Silicon Valley was the first to turn up halfway through first quarter, and it's been climbing ever since. Cities didn't climb up until somewhere into the beginning part of the second quarter, and that's where the other 4 areas turned out. So Silicon Valley was leading the way in the slowdown, or the increase in marketing time, depending on how you want to look at it. Here's the seller's ask price reduction. So this is average. So what you have to do is come over here and first determine you're about 1.3% down. So that's 1.3% price reductions for Silicon Valley. And the area that's doing the most price reductions is the Central Coast, and that's about 2.2% price reductions. The seller reduces their own ask price 2.2% before they get the offer in the door. This is the frequency of the sellers doing price reductions. Most common in the Central Valley at about 36% of the sellers are doing price reductions. Very close together with the North Bay and the Central Coast at 30%. Cities is somewhere right around 25%, and doing the least amount of price reductions is Silicon Valley at 18% price reductions. So less than 1 in 5 sellers are doing a price reduction. Here's the overbid. This is what buyers come in and do to get their offer accepted. So this is a lagging indicator. You can see in all 5 regions, the trend now is downwards. Silicon Valley, again, was the first one to change downwards significantly. And the peak is probably right at the beginning of second quarter. The drop off in cities is probably halfway through from second quarter. Drop off in North Bay was less steep, but probably happened a couple weeks into second quarter. and both Central Valley and Central Coast are basically middle of second quarter for the start of the decrease in overbid. This is the frequency of overbidding, most common in the cities. So that's still at 70%. Silicon Valley is down to about 63.5%. Then you come down to North Bay at 42%, Central Valley at 38%, and Central Coast at 32%. So still anywhere from a third to 2/3 of the sellers are getting more than their asking price. Here's the long-term appreciation, and has been for some time. The real takeaway is the lower appreciation in the cities. You can see that all of the areas started off somewhat together. Purple being Silicon Valley sort of rose to the top even before the pandemic. Cities fell down basically with the pandemic. It really dropped down. The other four were still fairly close together. Clearly, Silicon Valley is doing the best. Central Coast and Central Valley are close together, and North Bay is in between at 72% appreciation. Here's the median sold price. You can see that cities is below their record peak. Silicon Valley is right at their record peak, as is the Central Coast, as is the North Bay, as is the Central Valley. So the only area that is below their 2022 peak is the cities area, which is San Francisco and Marin. Here's the estimated payments, then be in the same order. Assume an 80% loan using the 30-year fixed Freddie Mac national average for high balance conforming loans. Here's the metrics for each county as well as each region. I also throw in the Bay Area because the media talks about it. You have the current number in the now column, the percent change from a week ago and the percent change from 5 weeks ago. You can get the actual number and then see where it's been going in recent history. And with that, we're back to the different chapters and timestamps in the YouTube description below. I appreciate you listening. I don't see any unmuted mics, so have a great week.